We're analyzing Snapchat, stock ticker SNAP, to see if it's a great business on sale. We're using the Select 6 analysis to look at the most telling financial metrics before estimating a fair value for Snapchat. Then we're giving a final rating to the business. Before we get into these valuable metrics, let's understand Snap's stock performance. Right now, Snap trades for $10.54 per share. Year to date, they're performing in line with the market. Their stock price is up 19%. In the last 3 years, however, Snap's stock price is cut in half. They're down more than 80% from their all-time highs in September 2021. Since being listed publicly, Snap is down 53% overall. It's been quite the ride for shareholders throughout this time. Snap trades just $3 below their 52-week high. The company's up $3 from their 52-week low. There's some short interest in the business. 4% of their shares are sold short. Snap's a big company. They have a $17 billion market cap. But the burning question is, why should we be paying close attention to Snap? Snap, which refers to itself as a camera company, has one of the most popular social networking apps, Snapchat, in developed regions such as North America and Europe. The firm has 375 million daily active users. Snap generates nearly all of its revenue from advertising, with 70% coming from North America. The firm's headquartered in Santa Monica, California. Now with this background, let's get into the numbers. Starting with metric number 1, we want Snap's average return on capital in the last 5 years to be above 14%. The average business earns 7% returns on capital. Looking for a benchmark that's double this builds in margin of safety based on the quality of the company. Snap's had negative returns on capital in all 5 of these years. They've been getting less negative throughout this time, but they're still nowhere near positive. This is because Snap has negative operating earnings, which is where this is being calculated from. Because of this is an X on metric number 1. Metric number 2, we're looking for 5-year revenue, net income, and free cash flow growth. This metric's all or nothing. All 3 need to be up for this to be a check. We'll also include their numbers up until today when we calculate this growth. In this time, Snap's almost quadrupled their revenues. Their earnings have been negative in all 5 of these years. Because of where the company's at in its life cycle, earnings may be unfairly penalizing the business. So when we look at the company's gross profits, these have grown by 7 times. The big thing to understand is that they haven't had a stable gross profit margin. While it has increased, it's fluctuated by a lot until just recently. Snap has also really increased their selling, general, and administrative expenses and their R&D expenses, which is partially the result for this negative operating income. A bright spot for Snap is that they are cash flow positive. They've been cash flow positive since 2021, meaning they've grown their free cash flows over this time. Because their net incomes or their earnings are down, even though this may unfairly penalize the business, this is still what we're looking for, and this is an X on metric number 2. Metric number 3, we're looking for earnings per share growth in the last 5 years for Snap. We learned their earnings have been negative in all 5 of these years. At the same time, Snap's diluted shareholders by 22%. This is huge shareholder dilution, even for a potentially high-growth software business. Snap's been one of the worst offenders for share-based compensation, decreasing shareholders' ownership in the business throughout this time. Because of this shareholder dilution and their negative earnings, this is an X on metric number 3. Does Snap have what it takes to turn it around in the back half of our analysis? Metric number 4, we're looking for cash flow per share growth in the last 5 years. Snap has grown their free cash flows over this time. This is outpacing their shareholder dilution, which means this is our first check of the day on metric number 4. Snap's free cash flows per share have grown. To recap where we stand currently, through 4 metrics, we have 1 check and 3 X's for Snap. During recessions, overly levered businesses can have the biggest losses. Metric number 5, we want Snap's net debt, which is their total debt minus their cash and their short-term investments, to be below the sum of their free cash flows in their last 5 fiscal years. Snap had a net cash position for 4 of these past 5 years. They added on long-term debt in their most recent year, ending that with $238 million in net debt. Right now they have $472 million of net debt. In this time, even though they're cash flow positive today, Snap has also consumed $1 billion of free cash flow. This means this is an X on metric number 5, as historically they haven't supported their debt position. This again may be potentially unfair to the business based on where it is in its life cycle. Having finally turned the corner to being cash flow positive, the company probably felt that they could add on some debt. In their last 12 months, Snap has produced $81 million of free cash flow. Even if we project that over the next 5 years, that's still not enough to currently support their net debt position. The big metric of them all, metric number 6, we want Snap's average 5-year free cash flow divided by their enterprise value to give us a yield that's above 5%. If this is the case, this gives a slight risk premium to the yield of the 10-year treasury. It's the first of 2 different ways we're estimating a fair value for Snap. Right now, Snap has a $17.6 billion enterprise value. This accounts for both their market cap and their net debt position. It looks at Snap similar to it being a private company. In the last 5 years, we learned they consumed free cash flow. Snap has a negative average free cash flow to enterprise value yield. On a current basis, Snap produced $81 million of free cash flow in their last 12 months. When that's divided by their $17.6 billion enterprise value, we get a 0.4% current free cash flow to enterprise value yield. That's well below the risk premium we're looking for. It's also below the yield of the 10-year treasury by quite a bit. Coming in on metric number 6, this is an X for Snap. Don't just throw the business out. We still need to estimate their fair value per share and give our final rating. Everything we've discussed so far is important, but there's something missing that in my opinion is the main reason to analyze Snap, which takes us on to using a discounted cash flow model to estimate their fair value. A DCF model is based on the predictability of a company's free cash flows. Like any model in any discipline, it's output sensitive to its inputs. Snap's not been a predictable business in its past. That's due in part to its high growth, its lack of a strong public track record, and where the company's at in their life cycle. This really impacts our assumptions. This estimate of Snap is a lot rougher than it would be for some other businesses with more established track records. Assuming Snap grows their free cash flows at 20% annually for the next decade, then assuming that these grow at 10% annually for the following decade, we add in their tangible book value to give an estimate of their net worth. If we want a 15% rate of return, which is what Warren Buffett looks for from his investments, from today's valuation multiples, if these are the same 20 years into the future, an estimate of Snap's fair value per share is only around $2. That's down a lot from their current stock price. Keep in mind some key points. Snap's business predictability and their lack of a track record is really what throws the company off. It's good to see that they've recently become cash flow positive, as free cash flows are the lifeblood of any business. They're ultimately how companies are valued. Keep in mind this is a rough ballpark estimate. Most importantly, it's not financial advice. It's not a buy or sell recommendation of any security. Consult with your financial advisor before making any investment decision. In just a minute, we'll give our final rating to Snap, but we need to address something first. We've covered the numbers, but the qualitative factors may be even more important for their business. What are they? Looking at the factors supporting a long thesis, number 1, aggressive investments in innovation, which also brought about Snap spectacles, may expand the firm's ecosystem, diversifying its revenue sources, and potentially making the company more profitable even earlier than expected. Number 2, Snap's hold on younger users may provide significant value to advertisers seeking to target a younger demographic. Number 3, with unique multimedia app features focusing on further differentiation, Snap's competing for social media market share with Twitter, TikTok, Facebook, and Instagram. We'd be remiss if we didn't cover the negatives of their business as well. Looking at the factors supporting a short thesis, number 1, by issuing only non-voting shares for its initial public offering or IPO, Snap's management is protecting its control over the firm, which can be viewed as a significant risk. Number 2, Snap is late getting into a market which Facebook dominates. Many of its users may also belong to other social networks, so the firm will continually have to fight to capture new users, their time, and interaction. Number 3, Snap may struggle to capture enough digital advertising dollars from incumbent platforms like Google, Facebook, or Twitter in order to drive the firm to sustainability. There you have it for a balanced perspective of some of the qualitative factors of Snap's business. Now it's time to give our rating. In our analysis of Snap, the makers of Snapchat, we learned this company is still growing very rapidly. They've recently become cash flow positive, but they're still not profitable on a GAAP basis. They have negative average returns on capital. They've also diluted shareholders by a lot. Snap doesn't support their current net debt position. It doesn't look like they're attractive compared to the yield of the 10-year treasury. Keep in mind this isn't financial advice. When we performed our discounted cash flow analysis, using those assumptions based on today's valuation multiples, if you want a 15% rate of return for Snap, an estimate of their fair value is around $2. Snap has never traded at those levels as a public business. Looking at all the factors of our analysis, Snap looks like a weak candidate for further research. Don't let that discourage you from digging into the business. If you enjoyed today's video, be sure to like it, subscribe to the channel for more stock analysis videos, share your thoughts about Snap, and let me know what business to look at next in the comments below. Thanks for learning about Snap with me, and have a great day.